Hey, good morning, options traders. What's happening, everybody? I wanted to help the new traders in the group with a topic that we look at a lot in risk management, and that is risks versus dangers. Now, in some ways, it's a little bit of a play on words, but it's an important play on words because there are some positions in your account that just simply should not be there. And this is what we would usually classify as a danger. So how can we figure out the difference between these two, and what can you do about it? Well, let's start with risk. Risks can be calculated. Now, this doesn't necessarily mean it can be a nice, clean, neat calculation like what's the probability of winning at roulette or the probability of drawing the ace of spades from a deck of cards. Those are absolutely known probabilities. And in the stock market, we can certainly calculate probabilities, but they're not necessarily that clean and neat. But we might say, what's the probability for an option to expire in the money? Or perhaps the probability that the earnings will be better than expected. And these are things that we call risks. They're unknown, but we can get some sense of probability. But with a risk, we have the potential for loss, but we also have the potential for gain. That's the reason that we're taking the risk. It's a calculated risk. We're putting money in the face of uncertainty in exchange for a potential profit. So things that would be risks would be buying shares of stock, buying options, buying a vertical spread. In all of these cases, you have the potential for gains, but you also have the potential for losses. So those are risks, and those are things that we're faced with pretty much every time we put on a trade. Well, what are dangers? A danger is a trade that has no upside, but only downside. Now, of course, nobody would intentionally put that on into an account, but they can occur over time. So whether it's the stock price maybe has moved in your favor, time has passed, volatility has changed, or some combination of all of the above, you can end up with a position that has no upside and only downside. Well, if you think about it, there's no sense in holding a position with no potential for gains, but that does have potential for loss. We'd have to say, what's it doing in there? There's absolutely no benefit. So for instance, let's take a look at vertical spreads. Let's say that you buy the 100-110 vertical spread. And so we see our bends at the strike here at 100 and at 110. The most this could ever make is the difference in strikes, or 10 points. And in this case, if we paid 5, the most we could make is 5. But that would be the 100-110 vertical spread. However, I can also see this as two smaller spreads. I could view it as the 100-105 vertical spread and then the 105-110. So for instance, if I buy the 100-105 vertical spread, I'd be buying the 100 call and selling the 105. And then if I later turned around and bought the 105-110 vertical, I would be long the 105 and short the 110. But notice when I put this second trade on, that the purchase of this 105 call cancels the sale of the 105 call over here. And so when it's executed, the second trade here, I would end up being long the 100 call and short the 110. And that is being long the 100-110 vertical spread. So that just shows that buying the 100-105 vertical and then buying the 105-110 is exactly the same thing as buying the 100-110 vertical. So why is that important? Well, if I view them as two separate trades, in blue is the 100-110, and in red is the 105-110. So you can see that if we went from the bottom of the blue to the red, and then from the red to the top of the red, it's the same thing as going from the bottom of the blue to the top of the blue. It's just two smaller vertical spreads within this larger one. So the reason that that's important is that we can end up with a danger. So let's say that we bought the 100-110 vertical spread, and it doesn't really matter what we paid for it, but right now it's trading for 8, and we'd like to continue holding it. We can squeeze out another $2 out of this. And so there is risk, because we could certainly lose the 8, but we could also make the 2. But now, let's take a look at them in pieces. Let's say that we're also long the 100-105, mathematically speaking. We're also long the 105-110, mathematically speaking. Remember, these two trades are not actually in our account. It's just this one. But mathematically, I could view it as these two. Well, let's say that we look at our broker's platform and we see that the 100-105 vertical is trading for 5. Well, what's the most this spread could ever be worth? 5. And it's trading for 5. It cannot possibly help us in any way. It just physically cannot get any more valuable, even if the stock goes to $1 million. This vertical spread is maxed out at 5. But it could hurt us. It could go to 0, or even just something less than 5. It's posing a danger, and you need to be able to recognize that. So what should we do here? Well, we could spin it out of the account, mathematically speaking. I could sell the 100-105 vertical spread. And when I do that, I'm going to be long the 105-110 vertical. So what happens is I've gone from the blue spread to this in red, just by that one simple trade of selling the 100-105 vertical. I've eliminated the dangers, but I've still kept the potential for gains by accepting a calculated risk. So for anybody who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course, all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.